If you think financial disasters happen because people are stupid, you've already misunderstood the most dangerous part. Because the truth is, the people who cause the biggest economic collapses are usually the smartest people in the room. And that's where things get uncomfortable. And yes, it gets worse. And somehow, even funnier. Imagine waking up in a world where numbers you trusted yesterday suddenly mean nothing. Banks are collapsing faster than people can panic. Markets are free-falling like gravity just turned personal. Savings are evaporating. Jobs disappear. Confidence dies quietly. And somewhere in a glass office tower, a group of highly educated experts stare at their screens thinking, "Wait, this wasn't supposed to happen." Even economists were panicking. Which is rare, because they're usually confused, not scared. Every financial disaster comes with a neat explanation. They tell us, it was unpredictable. No one could have seen it coming. The system failed. Bad luck. Market panic. Irrational investors. Pick your favorite excuse. According to the official story, the collapse happened because things just went wrong. But here's the problem. That story is clean. Too clean. And reality is never that polite. Because here's the part they never mention. Financial disasters don't come from ignorance. They come from confidence. Overconfidence. The people at the center of collapses aren't clueless gamblers. They are trained professionals with Ivy League degrees, decades of experience, and absolute faith in their own models. They don't say, "I don't know." They say, "I've calculated this." And that's where the danger begins. Because smart people don't just make mistakes. They build very convincing reasons to ignore them. It's like watching someone juggle knives while calmly saying, "Relax. I've done this before." But the craziest part is still coming. Because intelligence isn't the problem. It's the trap it creates. Every major financial disaster follows the same sequence. Not because history is lazy, but because human behavior is predictable. It starts with innovation. A new product. A new system. A new financial tool that promises to reduce risk, increase efficiency, or unlock wealth. Something that sounds smart. Then comes early success. Profits rise. Confidence grows. The smartest people get promoted. And suddenly, the system hasn't just worked. It's validated. At this point, skepticism becomes inconvenient. Because questioning success feels stupid. Then the warning signs appear. Small ones at first. A market behaving strangely. A number that doesn't quite add up. A model that works, except under pressure. And this is where intelligence turns against itself. Because smart people don't panic. They explain. And this is where everything starts to crack. Here's the uncomfortable truth. The smarter you are, the better you are at rationalizing risk. Instead of asking, "What if this is wrong?" Smart people ask, "How can this still be right?" They tweak assumptions. Adjust variables. Rewrite projections. They don't deny reality. They negotiate with it. And the system keeps running. Until it doesn't. Take 2008. The smartest people at Stearns, Lehman Brothers AIG, weren't idiots. They had PhD in mathematics. They'd been doing this for decades. They built complex models that could predict risk down to the decimal point. And they convinced themselves that housing prices couldn't fall nationwide. Not, wouldn't, couldn't. Why? Because it had never happened before. They looked at 50 years of data. They ran thousands of simulations. Their models said the risk was essentially zero. 1 in 10,000. 1 in a million. Basically impossible. So when a few analysts said, "Wait, what if housing prices do fall?" They weren't just dismissed. They were laughed at. Because the math said they were wrong. And when you have a PhD in mathematics, and decades of experience, and models that have worked perfectly until now, why would you listen to someone questioning your expertise? Then something small breaks. A subprime lender defaults. A hedge fund freezes withdrawals. Housing prices slip in a few markets. Nothing catastrophic yet. But panic doesn't spread instantly. Because smart people are still in charge. And smart people don't panic publicly. They issue statements. They say, "This is temporary. This is contained. This is under control." Spoiler. It never is. Here's what makes this even more dangerous. When smart people stay calm, everyone else assumes they should too. Investors wait. Governments hesitate. Regulators delay. Because no one wants to be the idiot who overreacted. So the system limps forward, bleeding quietly. This is how disasters grow in silence. Until one morning, everything that was contained becomes catastrophic. Eventually, reality stops asking for permission. Liquidity vanishes. Trust disappears. Markets freeze. Phones start ringing. And suddenly, the smartest people in the room realize the same terrifying thing. They don't know who holds the risk anymore. The mortgage you sold to a bank. Who packaged it into a security. Who sold it to a pension fund. Who used it as collateral for a loan. Who? Nobody knows where it ends. At this moment, intelligence becomes useless. Because fear doesn't care how smart you are. This is when money stops behaving like money. Assets can't be priced. Trades don't clear. Confidence collapses faster than balance sheets. If money could scream, this is the moment it would lose its voice. And the irony? The models still say everything should be fine. Because the models can't account for one thing. Human panic. But here's the detail everyone ignores. We like to believe financial disasters are technical failures. They're not. They're human failures. Specifically ego, groupthink, and broken incentives. Smart people don't collapse systems alone. They collapse them together. Because once a belief becomes shared, it becomes protected. And the more intelligent the group, the harder it becomes to challenge. Here's the dirty secret. Most people involved aren't rewarded for being right. They're rewarded for being confident. Bonuses reward growth. Promotions reward success. Warnings don't get applause. So when someone says, "This doesn't make sense," they're not seen as smart. They're seen as difficult. And difficult people don't last in booming systems. Eventually, the lie becomes too big. Confidence collapses. Everyone rushes for the exit. And suddenly, the same experts who told you everything was fine are explaining why the collapse was unavoidable. We couldn't have predicted this. Except, some people did. The ones who got laughed at. The ones who got fired for being too negative. The ones whose warnings were buried in footnotes. The smartest people in the room didn't prevent the disaster. They normalized it. They made the insane sound reasonable. They made the dangerous sound safe. Until it wasn't. Here's what most people miss. Financial disasters don't end when markets stabilize. They echo. They reshape housing costs, job security, interest rates, government policy. Decisions made in panic years ago are still quietly charging you interest today. That bailout in 2008? You're still paying for it. Through inflation. Through taxes. Through a weaker dollar. Through wages that haven't kept pace. Even if you never invested a single dollar, you're paying the price. Because when systems break, the people who broke them get bonuses. And everyone else gets austerity. You don't need to be rich to pay the price. The family sitting at their kitchen table right now, looking at bills they can't pay, didn't make bad investments. They just lived in a world where other people's confidence became everyone's crisis. Here's the truth no one likes admitting. Education doesn't protect you from financial disasters. Experience doesn't either. In some cases, they make you more vulnerable. Because the more you know, the harder it is to accept that you might be wrong. And the more successful you've been, the easier it is to believe that this time is different. Finance isn't numbers. It's human behavior wearing a suit. Money isn't logical. It's emotional chaos with a price tag. And every major financial disaster teaches the same lesson. Greed wins the short game and destroys the long one. But here's what makes it worse. They already know this. And if you think this story is disturbing, wait until you see what happens when the smartest people know the system is broken and keep playing anyway. Because that story is happening right now. And it's even worse. If this pattern sounds familiar, hit that subscribe button. Because we're documenting every major financial collapse and the psychology that creates them. Next video drops in 1 week. We're covering the collapse that everyone saw coming, but no one could stop. And trust me, the people involved knew exactly what they were doing. See you in the next file.